Hello class. This is a video tutorial of a couple of the questions from the back of chapter 19 from the Fundamentals of Corporate Finance text, 3rd edition by Perino, Kidwell, and Bates. In this video, we are going to go over questions 19.7, 19.9, 19.13, 15, and 17. So let's begin. 19.17, addition to retained earnings. Northwood Inc. has revenue of 455,316 and cost of 316,487 and pays taxes at a rate of 31%. If the firm pays out 45% of its earnings as dividends every year, how much earnings are retained and what is the firm's retention ratio? So the first thing you're going to want to do is identify the given. We have the revenue, right? From here, the tax rate 31%. We have the cost, the 316,487, and the payout ratio of 45%. So the retained earnings formula according to the text is going to be revenues minus costs times 1 minus the tax rate times 1 minus the payout ratio. So there's two things we have to do. We have to find the retained earnings and then the retention ratio. So the first step is to calculate the retained earnings, and using this formula right here, we do equals, open parentheses, and again, as I mentioned in a previous video, please get into the habit of putting in your formulas the cells that you're referencing from as opposed to typing in the formula here. It really helps expedite the process of troubleshooting in the event you hit an error in the future. So you want to do equals, open parentheses, D8, which in this case is the revenues, minus the cost, right? So we took care of this part here, close parentheses, times, open parentheses, 1 minus the tax rate, close parentheses, times, open parentheses, 1 minus the payout ratio, close parentheses. And when you do that, you get 52,685 and 61 cents. All right, and the second step is to calculate the retention ratio, and the retention ratio is just 1 minus the payout ratio, and that equals 55%. And if you check with the back of the book, it's really all you have to solve for, 55%, which means that all of this additional stuff is just extra. But give me the calculated retained earnings as well, because if you come across a question that asks for that, then you'll know how to do it, all right? 19.9, percent of sales. Cattail Corporation's financial statements for the fiscal year just ended are shown below. So then here you are presented with their income statement, their balance sheet. So Cattail Management expects sales to increase by 14% next year. Assume that the financial management accounts vary directly with changes in sales, that management has no financing plan at the time. Given this information, develop a pro forma income statement for Cattail for the next fiscal year. So the only thing we have to do is just make a clean income statement. That's all we're doing. So let's set it up like this. Expected growth rate in sales, we have 14%. The net sales, we have 1.5 million, right? And we're getting it from here, because even though it looks like it says 1,500, this is the figure in thousands, all right? So you just add 3 zeros to the end, so it's 1.5 million. So then the projected sales is going to be the 1.5 million times, open parentheses, 1 plus the 14%, and then you get $1,710,000. Next, we get the cost from above, 350,000. Again, it says 350 here, but we have to add the 1,000. And the projected costs are going to be equal to 350,000 times, open parentheses, 1 plus the 14% expected growth rate in sales. Right? So now pro forma income statement, right? We have the net sales. We can get rid of this because this is already going to be in millions anyways. So for net sales, all you do is just bring down the projected sales from here. For the cost, you just bring down the projected cost. So your net income is just going to be your net sales minus your costs, and that's going to be $1,311,000. That's it. That's all you need to do for 19.19. Don't 19.9. Don't get too fancy with it. All right. So skipping forward, 19.3, capital intensity ratio. McDonald Metalworks has been able to generate sales of $13,445,196 on assets of $9,145,633. What is the firm's capital intensity ratio? So given the total assets from above, the sales from above. All we have to do is just find the capital intensity ratio, and all you do is just divide the total assets over sales. That's it. So you just do equals total assets divided by sales, and you get the 68.02. If you get 68.0 or 68.022, that's fine also, but let's keep it at 2 decimal points, all right? So now you know how to find the capital intensity ratio, total assets over sales. So if you come across any other questions that ask you for capital intensity ratio, you have to make sure you have your total assets, you have to make sure you have sales, all right? And if you have to compute it, you have to compute it, but at least now you know. Next, 19.15. All right, internal growth rate. Swan Supply Company has net income of $1,212,335, assets of $12,522,788, and retains 70% of its income every year. What is the company's internal growth rate? So given we have the total income, the total assets, and we have the plowback ratio, right, of 70%, which we get from here. So the only thing that we have to do is find the company's internal growth rate. So if we look up the IGR formula, the internal growth rate, it's the plowback ratio, which we have, times the return on investment times the equity ratio, or plowback ratio times net equity over net income over equity times equity over total assets. We have total assets, or the plowback ratio times the net income, which we have, over total assets, which we have. So it looks like it's going to be this, doesn't it? So basically we have everything that we need to solve the problem. So IGR is going to equal your plowback ratio, which is satisfies this part, times, open parentheses, your net income over your total assets. And we're satisfying this part of it right here. And when you do that, you get 6.78, and we confirm with the back of the book that is the case. The back of the book says 7.8, but let's keep it at 2 decimal points. 6.78. All right, so for this one, you just have to make a chart, and it's not that difficult to make. So 19.17, EFN and growth, refers to exhibits 19.10 and 9.11 in the text. The EFNs for several growth rates for Empire Enterprises are as follows. So here you have growth rate, you have in percentages 0, 5, 9.6, 10, 15, and 20. And then EFNs of negative 4.8, negative 2.30, nil or null, 0. You have 0.20, 2.70, and 5.20. As a drill, you may want to check the calculations and plot the line or replicate the graph in exhibit 19.11. So all you're really doing is just replicating this chart here. And the way that you do it is you just the easiest way to do it, and I'm just going to try to mimic it again because there is a bit of a trick to this. Select all of this, press Command if you are on a Mac, or Control to select that. So now you have all of this selected, and then you want to go to charts, line, and then marked line. So what it's going to do is it's going to create the same line all over again. But the problem is that you have across here 1, 2, 3, 4, 5, 6, and you don't want that because you want this to be reflected on here, right? Just like this chart right here, 0, 5, 9.6, right? 0, 5, 9.6. So the growth rate in percentages. So what we have to do is modify this horizontal axis, and I think I did it like this. Okay, so what you do is you select here, make sure that the horizontal category axis is selected, right click, and then click on select data. So then if you remember, this is up and down is the y-axis, left and right is the x-axis. So what we're doing is we're changing the labels, right? So that we're adjusting category x-axis labels. So we click here, and now it's asking us to select the data source, right? So we select this range there, and then press enter, and then hit OK. And that's it. And that's how you get the this line to be like that. So this is your answer. You have to produce a chart that looks like that, right? So let me show you what it looks like if you don't do it like that, and if you just select these two and you do a line chart, you're gonna have two lines, and you don't want two lines. That's not what you want. You want this x-axis to be equal to the growth rate and percentage, and that's basically the way that you do it. You have to program this x-axis to be equal to the growth rate, and then just produce a line, and this should match what you have in the textbook. And this concludes our video tutorial for chapter 19 from the Fundamentals of Corporate Finance text, 3rd edition by Perino, Kidwell, and Bates. If you have any questions, comments, or concerns, please feel free to reach out, and I'll be more than happy to help. Thanks for watching.